The US stock market is great, but what if you want income that isn't directly tied to what the Nasdaq is doing? In 2020, Chinese internet stocks finished the year slightly ahead of the Nasdaq. After that brief outperformance, 2021 was the beginning of a 4-year bear market for China. Fast forward to 2025, and there's something going on here. Today, we'll look at a China-focused fund that recently turned a corner and yields a whopping 24%. I've been avoiding KLIP or KLIP so far for 2 reasons. Number 1, NAV erosion. Look at the price since inception, down more than 50%. That's assuming you withdrew all the income. The yield has been huge, so if you reinvested all of it, the total return was actually positive. 31% since early 2023, which isn't really that good, but it's not a loss. So to maintain your capital, you would have had to reinvest a chunk of your distributions. It's doable, but it's not really desirable. Secondly, China wasn't a great place to invest from 2021 to 2024. Both of these factors have changed course, as we'll see shortly. Let's start with the income because there's a lot of it. The distribution history for KLIP is important because it shows the impact of a policy shift in January 2025. Before that change, distributions were all over the place, ranging from 22 cents to more than $1. Snowball is handy for distribution charts like this, but I mostly use it to combine my stocks from 3 brokerages into one dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a free trial and a discount. Now, the wild swings in KLIP's distribution payouts were because the fund paid out all the option income every month, and option premiums vary based on volatility. On average, they distributed a lot of income, but the 100% distribution policy, along with the option strategy, which we'll get to shortly, caused the price to decline. The new policy is to cap distributions at 2% of the NAV per month. Anything above that gets reinvested back into the assets of the fund. Let's check the numbers. Here are the 2024 distributions before the distribution policy change. With the exception of December, every month was well above 2% of NAV. A reminder that this is an ETF, so the price of the fund and the NAV are either equal or very close to equal. Here's 2025, and we can see the 2% distribution policy in place. The 2 most noticeable changes are number 1, more consistent distributions, and number 2, the price of the fund doesn't have to look like a downhill ski slope. Despite the policy shift, a 24% yield is still huge. That's 2% a month times 12 months. Some websites show a higher yield at the moment because they use a trailing 12-month formula, but that doesn't account for the recent change in distribution policy. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%. This one is an exception at more than 20%. And if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. The KraneShares KWEB Covered Call Strategy ETF, ticker KLIP, is an income fund that's focused on Chinese internet stocks. To understand what it is, we have to start with KWEB, KWEB, which is a $10 billion ETF operated by the same fund manager, KraneShares, which is based out of New York. KWEB invests in Chinese internet companies. It's a passive index fund, meaning it mirrors the CSI Overseas China Internet Index. Even though the companies are Chinese, these stocks are traded on either the Hong Kong exchange or US exchanges. The basic concept here is that most profitable companies in the world are American companies that make money on the internet with products like Google, Facebook, and Amazon. The Chinese government doesn't allow them to operate in China, so Chinese companies offer similar, highly profitable services. Even though China has a lower average income than the US, it's still an attractive market because of its size. More than 1 billion people connected to the internet, about triple the US. Let's take a look at the holdings. KWEB is heavily weighted to its top 10 holdings shown here. You probably don't recognize all the names, so let me add a few extra details. Now, I've simplified these descriptions to focus on the major business lines only. And that brings us to the subject of today's episode, KLIP. As we saw earlier, KLIP prints money like crazy. The problem has been the declining NAV. Let's start with those fairly substantial distributions. KLIP holds KWEB shares and sells call options on those shares. KWEB is a highly volatile ETF, so the options bring in a huge premium, which explains why the yield is so big. This chart from the Why KLIP Stands Out Among Covered Call ETFs analysis on Seeking Alpha puts it into context. KWEB's high volatility translates into option premiums that are more than double what the S&P 500 options pay. I use Seeking Alpha to research KLIP and every other stock or fund I bought or sold since retiring. I tried Morningstar, Dividend.com, and every other investing website, and Seeking Alpha is the only one that provides decent analysis for income investing. I use it every day. Link in the description for a free trial and a discount. KLIP's specific option strategy, according to the prospectus, is to sell at-the-money calls on KWEB. That means when they sell the call option, they maximize income by selling away the rights to all the upside compared to the current price at the time the option was sold. If you sell all the upside and distribute all the income, no surprise that the NAV was trending down. Generally, I prefer the strategies that fund managers like Neos use, which is to sell call options out of the money, meaning above the current price. If they sell 3% out of the money, that means they can capture up to 3% of the potential appreciation, and the rest goes to the option buyer. So to summarize, this at-the-money strategy maximizes income but is a negative for the NAV, and the new policy to reinvest distributions over 2% per month is a positive for the NAV. This is why the long-term price trend for KLIP has been negative, but the year-to-date price for KLIP has been positive. The taxes are confusing, as tends to be the case for these funds, but the trend is going in the right direction. First of all, ignore the 19A1 notices because they're just estimates and often wrong. Looking at the official tax statement attached to Form 8937 from Crane Shares, we can see that the tax treatment switched from 0 return of capital to 100% return of capital in January of 2025. This is kind of ironic because if they were actually returning investors' money back to the investors, it would be the other way around. Given that the price started going up when the return of capital distributions began, my assumption is that it's a tax treatment, which is a good thing. It means no tax due until you sell, and then it lowers your cost basis and is taxed as capital gains rather than ordinary income. Operating expenses are 0.95%, which is high-ish, but typical for funds like this. Also, KLIP holds KWEB, which in of itself has a 0.7% expense ratio. Now, you could argue it's a bit expensive given that this is a passive strategy based on a passive index fund, but the reality is I haven't found any competitors. So where else can you get high yield from Chinese internet stock? To understand the risks of investing in China, you have to consider the 2021 crash. Chinese internet stocks, as represented by KWEB, roughly doubled from 50 to a peak of 101.8 in February 2021, which is amazing. 100% appreciation in just over a year. Then it dropped like a rock, losing about 75% of its value in just 1 month. Crazy time. So why did it crash? Well, the primary reason was the Chinese government introduced antitrust policies aimed at Chinese tech stocks. The measures included banning the practice of internet giants requiring merchants to sign exclusivity agreements that reduce competition. In general terms, the increased regulation reduced the profitability of the tech giants. Now, you could argue that this type of antitrust regulation is also found in Western economies. The second reason, however, was a different matter. The Chinese government introduced a requirement that all English tutoring businesses operate as non-profit entities, effectively banning for-profit English schools. The reasoning was that this would make education more affordable for students. The issue for investors was government interference in the marketplace. The ban caused the price of education stocks to collapse, but the bigger implication was that if the Chinese government could snub out one type of business, it could happen to others. This uncertainty about potential future government interference sent investors packing. Lastly, There was the Evergrande real estate collapse around about this time. The government introduced debt limits to reduce systemic financial risk, and the result was the deleveraging of Evergrande, which went into liquidation. Now, on the flip side, the Chinese government also provides assistance to Chinese internet companies via policies like the Digital Silk Road Initiative, with subsidies to build out 5G networks and data centers and invest in AI. So now we know why the Chinese internet stocks crashed in 2021. Let's fast forward to today. The level of interference from the Chinese government has actually tapered off, and the level of interference from the US government has increased, specifically tariffs and the US federal government taking ownership positions in private tech companies. Now, I'm here to explain what's going on with KLIP, not to give my opinion on US or Chinese economic policy, but as I record this in October of 2025, this is what the market is saying so far this year. Year-to-date total return for KWEB, which represents Chinese internet stocks, versus the NASDAQ 100, which is also tech-focused. Then I'll add XLK, the $92 billion fund that is more heavily focused on the fastest-growing US tech stocks. Is China hot right now? I'd say yeah, that's what the market's saying. Let's look at KLIP versus KWEB. Normally, growth investors would hold KWEB with its tiny little 2% yield and just hope for appreciation. Then income investors would buy KLIP with its 24% yield and just hope the NAV holds up. And typically, the price that the income investors pay for getting their returns in the form of cash today is a lower total return than the investors that leave almost all their money in the fund to just let it ride. So, given that backdrop, I was surprised to see this chart. Since KLIP's launch on January 11th, 2023, it has delivered a much higher return than its underlying asset, KWEB, and far less volatility. So, what's going on here? Well, covered call funds don't always underperform their underlying asset. This was discussed with NEOS co-founder Garrett in a recent episode about the pros and cons of covered call funds. Until recently, Chinese internet stocks have been in a bear market, and covered call funds can outperform in flat or bear markets. Going forward, if the Chinese bull market continues, then this will reverse and KWEB will outperform KLIP. We can see this over the short term by comparing their total returns year to date for 2025, and KWEB has now taken the lead. Obviously, investing in Chinese internet stocks comes with risk, but many of those risks are different from the risks of investing in US tech stocks. As the two economies become more and more disconnected, investing in China becomes more interesting because there's potential for one to be up while the other one is down, and vice versa. KLIP checks the box for income and also for diversification. I haven't purchased KLIP yet, but it is on my shortlist. My plan would be to spend about 8% of that 24% yield and put the other 16% to work elsewhere in my portfolio on less risky investments. If and when I do buy KLIP, I'll send out an update via Armchair Insider. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find videos of my favorites, click here for reviews focused on my top 10 holdings. And that wraps it up for this look at KLIP. More Armchair Income coming soon.
Armchair Income.